Hi everyone, welcome back. I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today, 4 things. First, the Iran war and who actually won, because the answer is not what you think. 2, why these caps could force the Fed to print money and what signals to watch for. 3, an original analysis we did on AI deflation that I think changes how you should think about inflation. And finally, a few quick items on my radar before we wrap. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions. Let me start with a number that reframes the entire Iran story. Russia just earned $5.8 billion in extra government revenue in 18 days. From a war, it did not even start. I will come back to why that matters, but first, the conflict itself. Because the situation on the ground does not necessarily match what the headlines are telling you. Trump posted a 5-day pause. Markets rallied, everyone exhaled. But I think that reaction was wrong, and here's why. Iran has not acknowledged or accepted the pause. It takes 2 sides to pause a war. There were 580 million in suspicious oil trades placed roughly 15 minutes before Trump's post. Someone knew. And thousands of Marines are arriving in the Gulf during this so-called pause, with more units en route. A Marine expeditionary unit is repositioning toward Qatar Island, which is Iran's primary oil export terminal. That does not look like de-escalation to me. That looks like repositioning under the cover of diplomacy. Now, I still think this conflict ends within 2 to 3 weeks. The political math has not changed since the last episode. Trump needs cheap oil before midterms. The Gulf states are bleeding capital. Iran's military capacity is degrading by the day. Everyone has incentive to find the exit. But here's what I think most people are missing. It doesn't matter when the war ends. For some parts of the world economy, the damage is already done. About 2 weeks ago, Iranian missiles hit Ras Laffan, the backbone of Qatar's LNG exports. Roughly 13 million tons of capacity is now offline. There is about 17% of the total exports. And this is not the kind of thing you can fix in a few months. 2 major LNG trains were destroyed. The restoration timeline is 3 to 5 years. Think about what that means. 26 billion in damaged facilities. 20 billion a year in lost revenue. From a war, Qatar has 0 stake in. Countries like Italy, South Korea, and China had long-term contracts with Qatar for that gas. Those contracts are now worthless, which forces everyone into the spot market at the same time, competing for a shrinking pool of supply. And there is a physical reality that is about to make this worse. The tankers dispatched before the conflict started have now arrived in Asia. Those pre-war shipments have been unloaded, but there is nothing behind them. Over the next 1 to 2 weeks, Asia faces a supply gap. The ships that would normally be en route were never dispatched. Even if a ceasefire is signed tomorrow, you cannot fill that gap overnight. And the Qatar LNG capacity I just mentioned is gone for years, regardless. Now, back to Russia, because this is the part of the story I find most consequential. India and China still need energy. They're not going without. They're simply buying Russian crude instead of Gulf crude. And because everyone needs Russian oil now, Russia's discount to Brent collapsed from $20 a barrel to $5. Russia went from selling at a steep discount to selling at nearly full price overnight without doing anything. 5.8 billion in extra revenue in 18 days. Extrapolate that for a full month and it clears roughly a quarter of Russia's entire 2026 budget deficit. Give it 3 to 6 months and Russia's fiscal pressure largely disappears. The planned VAT hikes can be scrapped. Defense spending can increase. And most importantly, Putin no longer has any urgency to negotiate on Ukraine. Before this war, Russia was negotiating from a position of fiscal pressure. Now, the pressure is gone. His leverage has completely flipped. So, here's my read on the overall situation. The war probably ends soon, but the question that matters is not when it ends. It is who comes out ahead and who takes a permanent loss. The US will be fine. It is a domestic energy producer. Russia is actively better off than before the war started. But Qatar faces years of rebuilding. Europe is more energy dependent, not less. And the countries that relied on Gulf LNG contracts are now structurally exposed. Those are not positions that reverse when a ceasefire is signed.
This episode is brought to you by Anderson, a global software development company building high-quality custom solutions for finance, healthcare, and beyond.
Now, if this conflict does not resolve in the next 2 to 3 weeks, the economic damage I just described starts cascading into the financial system. And that is when we start looking at the possibility of significant monetary easing across major economies, including the Fed. The Fed is already expanding its balance sheet. Since December, it has grown by about 120 billion. That is real and it is happening. But by historical standards, it is modest. During the 2008 global financial crisis, the Fed expanded by 1.3 trillion. During COVID, 4.8 trillion in 2 years. What is happening now is nowhere near those levels. And what concerns me is the cascade that could change that. And it starts with what I just showed you. If energy prices stay elevated for months, not weeks, which the Qatar damage alone guarantees for gas, energy importing nations start running out of options. They have to pay for oil and gas somehow. For countries without enough dollars, that means selling financial assets, selling treasuries, selling gold, selling whatever they can liquidate to get dollars. Turkey is already doing this. And we are already seeing the result. Since the war started, there has been a persistent bid for dollars. Everything else down. Treasuries sell off, yields rise, and that means higher mortgage rates, more stress on private credit, and more pressure on every leveraged position in the financial system. And this is where the Fed gets trapped. Inflation is rising because of energy, the economy is weakening because of the same energy shock. The labor market is softening. They cannot cut rates because inflation is too high. They cannot hike because the economy is too fragile. They are frozen. But there is one thing the Fed will always do, regardless of inflation. If the treasury market or the overnight funding market breaks, they step in with liquidity. They did it in 2008. They did it in 2020. They did it for Silicon Valley Bank in 2023. Financial stability overrides everything else. That is not my opinion. That is a stated policy. And I think the financial system is more fragile right now than most people realize. Private credit. I've been covering this since episode 2. It keeps getting worse. Alternative asset managers have lost 265 billion in market cap since January this year. Blackstone's biggest fund posted its first loss since January 2022 and saw 3.7 billion in redemptions. BlackRock is getting withdrawals. Morgan Stanley is getting. Apollo is getting. Moody's just got one of the major funds to junk. And here's the part that connects everything. Somewhere between a quarter to 40% of private credit is loans to software and technology companies, depending on how broadly you define the sector. AI is actively disrupting these business models. And you can see it in the prices right now. The IGV software ETF continues to decline. Microsoft continues to go lower. Everyone is talking about Iran, but software is falling because of AI, not because of the war. The collateral backing these loans is deteriorating in real time. There is a 162 billion maturity wall hitting over the next 18 months. If enough of these loans go bad, and default rate projections are now at 8%, private credit becomes another crack in the financial system that forces the Fed's hand. So here is exactly what I'm watching. Two things. The MOVE index, which measures treasury market volatility. It is elevated, but not at crisis levels yet. And stress in the funding market, specifically the Fed's repo facility and the swap lines with the major central banks. Both are quiet right now. When you see those activate, that means dollar shortages are becoming acute globally. And that is your signal that we are moving from modest balance sheet expansion to something much more significant. Now, all of this is still conditional. The war needs to keep dragging for this cascade to fully play out. But 2 weeks ago, nobody thought the conflict would last this long. The probability of it continuing is increasing. And with that, the probability of significant easing by central banks around the globe, and specifically the Fed, is increasing too. That is the shift. Not that printing is guaranteed, but that the odds have moved meaningfully. And why does this matter? If the Fed is eventually forced to stabilize financial markets and stimulate the economy in a meaningful way, history tells us that is when the risk assets turn. The cascade is building. The signals are identifiable. The question now is timing. There is another force at work right now that has nothing to do with war, and I think it deserves more attention than it's getting. Everyone talks about AI being deflationary, but nobody actually puts a number on it. I wanted to know, so we built our own model. And what we found surprised me. Here's the uncomfortable truth that most people skip. When you actually look at the cost structure of each sector in the inflation basket, AI can only touch 5 to 20% of costs in most industries. The rest is raw materials, physical labor, land, energy, and commodities. AI cannot make a chicken cheaper. AI cannot make rent lower. AI cannot reduce the price of lumber or concrete. The thing AI is genuinely great at: automating admin, billing, customer service, coding, scheduling. That layer is a surprisingly small share of what consumers actually pay for. And even on that small layer, there is a second filter. In competitive industries like retail and telecom, when companies cut costs with AI, those savings eventually reach the consumer through lower prices. But in regulated sectors like healthcare, education, and insurance, they mostly don't. When an insurance company uses AI to process claims 40% faster, your premium does not go down. They keep the margin. When we run all of this across 16 sectors, model the direct cost savings, the jobs that get eliminated, and the reduced spending from displaced workers, and included the inflationary offset from data centers' energy demand. Our probability-weighted estimate for 2030 landed at about 0.6 percentage point of annual inflation drag. That is real. It is roughly comparable to what globalization did over the decade after China joined the WTO. Per household, it's about $850 a year in savings by 2030. But it is not the deflation tsunami some people are predicting. And the biggest reason is housing. Shelter is 37% of inflation basket, and AI does almost nothing to reduce housing costs. That single constraint caps the whole estimate. Now, I want to be clear about what this analysis does and does not assume. We are modeling what current AI can realistically do over the next 5 years. We are not assuming that healthcare gets fully disrupted or that surgeons and doctors get replaced by robots. If that eventually happens, and with advances in robotics it probably will, then these numbers get much larger. But this estimate is grounded in what we know about AI today and realistic adoption timelines. Think of it as the floor, not the ceiling. And the biggest uncertainty in this whole analysis is not whether AI reduces costs. It clearly does. It is how fast companies actually deploy it. And historically, big corporations have enormous inertia. Changing workflows, retraining people, integrating new systems into existing processes. That is slow and difficult work. Fewer than 1 in 10 firms have what you would call mature AI deployments right now. The technology is ready. The corporate world is not. Everything in this estimate depends on how quickly that gap closes. But there are signs that the gap is closing faster than expected. Zuckerberg is building a personal AI agent to help him run Meta. Not a chatbot, an executive decision layer that replaces the need for management layers in between. Meta is also cutting 20% of its workforce while spending $135 billion on AI. The stock went up on this news. And across the technology sector, you are seeing the same pattern. Companies cutting headcount and redirecting that spending into AI infrastructure. When the market rewards you for firing people and buying AI, that changes the incentive structure for every CEO watching. And Anthropic published data this week that confirms this is happening at scale. 49% of all jobs have now had at least a quarter of their task performed using AI. It was measured, not modeled. And the people who adopted early are 10% more successful at getting results. The gap between early adopters and everyone else is widening, not closing. Now, here's how I think about this. AI is creating a structural deflationary force that is permanent. It is not going away. And that actually has a silver lining for policymakers. We have seen this before. In the 1990s, the productivity boom from computers and the internet allowed the Fed to keep rates low even as the economy grew strongly, because the technology was keeping inflation in check. AI could play the same role in the next cycle. If unemployment rises because of AI-driven displacement, the deflationary impact gives central banks more room to cut rates and stimulate without worrying about inflation spiraling. AI creates the problem, job losses, and simultaneously creates the policy space to respond to it. That dynamic is going to define the next economic cycle. Now, before I go, a few things on my radar. The Philippines just declared a national energy emergency yesterday. President Marcos signed a year-long emergency order because fuel prices have nearly tripled and the country has about 45 days of supply left. This is exactly the kind of impact I described in Story 1. The Philippines is a net energy importer. It depends on Gulf shipments, and those shipments are not coming. This is the supply gap playing out in real time in a country of 115 million people. If these drags on, they will not be the last. On the data side, we got the first economic numbers since the war started, flash PMIs for March. Manufacturing across France, Germany, and the US is holding up reasonably well. Services across the same three countries mostly okay. But European services showed notable weakness, and services is 75% of the economy. That is the number I'm watching, because if the broader economic fallout from the energy shock starts showing up in European services, that is where the real damage to growth materializes. That's it for today. The war will probably end soon, but Russia is richer. Qatar is wrecked for years, and Asia's energy crunch starts now. If this drags on, the cascade leads to significant central bank easing. Watch the move index. Watch the stress in the funding markets. And while everyone focuses on the war, AI is quietly building a structural deflationary force that does not go away when the shooting stops. The war is temporary. The AI shift is not. Okay guys, subscribe, notifications on, new episode every week. See you next week.